Hit it.
It's Friday, May 31st, 2024, episode 240. I'm Patrick Saruzna.
And I'm Kevin Muir. This week, we have the great pleasure to welcome Tucker Scott from Bergen Park Capital. We learn about his career managing the Templeton Mutual Fund, and then he gives us his picks for cheap foreign value stocks. And when I say cheap, I mean dirt cheap. Then Patrick steals some crayons from the kid next to him to draw some lines on his charts to help us tell him where the markets might be heading.
And folks, we might even drink some beers along the way. So Danny, jump on. What beer am I drinking today?
Today you're drinking Corponicus, I think it's called. It could be close to something else, but this is an open source, decentralized beer. They use crypto and they also collab with other breweries. So this is basically one big collaborative beer. No tasting notes.
Yeah, well, it's actually
No,
it's
they're
okay.
tasting notes. They're up in the cloud.
It's not bad at all. All right. Give us some side effects, bud.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include volatility vertigo, profit palpitations, or panictitis.
All right, let's get to the guest.
It's our great pleasure to welcome to the show Tucker Scott, the founder and CIO of Bergen Park Capital. Tucker, thanks for coming on.
Well, it's great to be on. Thanks.
I'm looking forward to this. First of all, because you live in Montana and you are a skier, and we will talk about that. But before we do that, we're going to talk a little bit about markets. But before we talk about markets, why don't we get to know you a little bit better? First of all, did you grow up thinking you were always going to be kind of a value cap stock portfolio manager?
I wouldn't go that far. My dad was actually in venture capital. I grew up in Menlo Park, California.
Okay.
And so I was exposed actually to a lot of growthier situations, I suppose. But as I got out of undergrad and went to work for a small money manager in California, I quickly realized I was a value guy. It just clicked with me. So I never really.
Oh, that's funny.
Yeah, never had any.
And your dad was the opposite, right? Being a venture cap guy, he must have been shooting for the moon, and then
I always felt he was a bit out of, maybe a round peg in a square hole or whatever the right term is. But, because I think he was probably a little bit more of a value guy, but was kind of forced into owning a lot of these high growth situations. And he was, to be honest, I think he would have been a better value investor than a venture capitalist. He had some good success, but I think he was maybe more built for value investing.
Did you go to school for finance, or could you just walk us through a little bit of your education, your background that way?
I did a history degree at University of Virginia, and then went and worked for a few years, and then I went back to Dartmouth for an MBA.
All right. What possessed you to go across the country and fly to the other side?
Yeah. I visited University of Virginia. And I just fell in love with it. It just felt like college to me. And I knew a few people that had gone there. There were 2 years ahead of me at high school, and both came back with, great reviews. And so I don't know. I just fell in love with the actual physical place, and the people were great.
And why did you choose history?
Well, I've always been I still read a lot of history. I think it was just my interest. It led me there. I've always been very curious about how things work and how we got to where we are. And, the way people try to explain what's happened in the past is also fascinating.
Do you feel that that's actually done you well in terms of your investment career?
Absolutely. I think certainly, when I investigate a company, I start looking at its history and trying to figure out, what's the story of this business? What are the important elements to it as we try to figure out what the future should look like. So there's some definite commonality there in terms of, piecing together a historical narrative.
And then when you went back to Dartmouth was that a typical finance degree, or did you do something different?
No, that was pretty straightforward MBA. So it wasn't,
okay.
There was no focus in it, although I did do a lot of, investment related classwork.
And so you go to Dartmouth and you come out, do you go to Wall Street? What was your kind of first job, like post MBA?
I did a brief stint at a firm in Connecticut, which was going to be a management buyout from one of the big insurers there. And that deal fell through. So the reason I joined kind of left, and then So about a year after graduation, I joined Templeton, Franklin Templeton,
Right.
the Templeton group that's based out of Nassau. And my first stint was out of Fort Lauderdale. So I moved down there.
Oh, wow. I didn't realize that's where their U.S. headquarters are.
That's right. So 30-minute flight from Nassau.
Oh, right. And what did they have you doing?
I started as a small cap analyst. And then within a year, I was promoted to fund manager and took over, actually within 2 years, took over our small cap funds. And so there, for the rest of my career, I was fund manager and analyst. We did both. So we didn't have a 2-track structure like a lot of firms do. All of us did, all of us had responsibility for a global industry group or two. And then we also, more senior people had fund management roles.
And so what year was that you you went to Templeton?
Well, that was 96, fall of 96.
Oh, geez. Okay. So right before the .com bubble.
Yeah. Well, and more relevant for me, that was the Asian crisis was only a year away, where those markets.
Oh, yeah. Because you're doing foreign stuff. Okay. So to walk me through that, you're a young guy, you get this job in Templeton. The next thing you know, you're managing money within a year or two. And then all of a sudden the Asian crisis hits.
Yeah.
What was that experience like?
Well, it was an eye opener because, I certainly had never seen price action like that. That was, tell you a little story. So, Hong Kong was getting hammered, and this is going into 1998. It was about a year long bear market. And near the end of it, as I recall, October of 2000, and 1998.
Yeah.
Mark Olowesco, who was running our big funds out of Nassau, was literally the only buyer of Hong Kong stocks until the HKMA stepped in. And if you recall, they stepped in and bought, I forget the exact percentage, but something like 10% of all the stocks on the Hong Kong exchange, and sent the market up 20%. But that was an eye opener for me in the sense that markets can really break down. There can be just people so scared that there's nobody on the buy side except yourself. So that
so what gave you guys the confidence to stick in there and continue to buy?
Well, that you have to ask. That was I was holding a lot of those companies, but I was managing very little money at that point, and I was buying, but
right.
It was really our big funds that were, as I say, the vast majority of the volume over there for weeks. So we ended up owning a whole bunch of that. And that turned out to, in the fullness of time, that was a very good trade. It was a bumpy one. But
I don't think people appreciate like how volatile it was and then how crazy it was in terms of when the Hong Kong Monetary Authority jumped in and bought stocks.
Yeah. I think this is the takeaway I took from that was that if they had not done that, the peg could have gone, the market, it could have been a lot worse than it was. There was just a tidal wave of supply, and it was really, as I say, it made a big impression on me.
I always think that you hear stories of guys that they experienced the 2008 crisis, and they realized that the banking system could go. They realized that it was more precarious than they ever thought. I guess you experienced it a little earlier than they did.
Yeah, although I had just moved to Nassau. I made that move in 2007 and started running one of our flagship funds, the Templeton Foreign Fund. So that it was a similar kind of situation. I stepped in, and within 3 months of the move, already we were losing Bear Stearns, and but it's a fair point. I mean, it wasn't completely fresh to me in the sense that I'd kind of lived through that in Asia, and but in a similar way. I mean, I think that one, March of 2009 lows. I got very aggressive in terms of buying into a lot of the stuff that had gotten crushed. And 2009 turned out to be one of my better years running that fund, as we had a very sharp recovery from a lot of the depressed, stocks that had gotten unreasonably crushed, typically consumer facing in the UK and the US in particular. But it also was it brought out, I think, how temperament can be a big differentiator among fund managers, because I was part of a group, and we had very wide guide rails in terms of what we could do as fund managers. So
Okay.
I would say the majority of people were kind of deer in the headlights and really, going towards the defensive end of the market, and really just trying to, have as little risk as possible. And there were, a couple of us that basically went the other direction. And, I guess, maybe if things had turned out differently, we might have had egg on our face, but, we got through that period. And, my general thought was, if it gets much worse than this, we're all out of jobs. We got to kind of,
It's like that famous line about the Cuban Missile Crisis, the trader on the New York Stock Exchange floor, that on the Friday afternoon he was buying all the stocks, and the young kid said to him, why are you doing this? He goes, well, if there's a nuclear war, it doesn't matter, and if there's no nuclear war, you want to be long. So I guess it was almost one of those. Did you find that that is on your best trades, you're offside? Like, because I'm assuming you were offside for a little while. You can't pick the bottom exactly. Are your best trades often that kind of environment where you're, you're averaging down into some sort of panic?
I would say that thankfully that doesn't happen all that often. I mean, much more common is finding a situation where the company's fallen out of favor for, a reason or set of reasons that, upon full consideration and thinking about the nature of the business, you think that the market is, being short-sighted and not willing to look through and see, the potential for the business. And this happens for all kinds of different reasons, but that general story probably applies to, 70 or 80% of the successful investments I've made over time.
And when you're buying those companies that are out of favor, though, in terms of, are you trying to figure out the catalysts ahead of time, or are you just like, I'm buying this cheap company and eventually the market will start to figure it out?
Well, I like to say that I want to make sure there's no impediment to a catalyst happening. So,
okay.
That's the way I would kind of frame that. Oftentimes you don't know what the catalyst is going to be, but you just want to make sure that, if you have let's say there's a controlling shareholder who's done some questionable things in the past that, would kind of keep a value crystallization event from happening. Those kind of things are deal killers. And also a management team that has, had any questions about their past decision-making around things that are important to shareholders. If there's any whiff that they're not fully on board, then, you don't want to be there.
So if you were to find a company that you thought was attractively priced, but then the management kind of, you met with them and you were like, oh, geez, these guys aren't on the up and up, would that just be an instant strikeout and you wouldn't even be tempted to buy that name?
It would almost certainly be a strikeout. I mean, and there might be some certain situations where, I don't know, there could be, potential for corporate activity or something like that, where you thought there was a reasonable shot these guys were going to be gone.
Okay, right.
But other than that, no. I mean, management is very important, but, first of all, I only talk to maybe 1 out of 4 companies that I invest in. You can really learn about management just from, reading what they say on calls, reading their documents, looking at their presentation materials. You get a real sense for, kind of what's important to them and how they're managing the business and where they see it going.
Well, that's interesting. I wouldn't have expected that. Do you think you're unusual in that you only talk to 1 in 4? Wouldn't most kind of small cap value guys be talking to each manager? And do you think that that's an advantage to you, not chatting with the managers?
Well, it's I mean, I used to talk to management quite a bit more in my prior role at Templeton. We had access to a lot of companies. And the honest conclusion was that I think I got misled slightly more than I was enlightened, is really the takeaway. So
that was always when people offer me to talk to management, that's always what I say as well, because if they're a great salesman, I'm just going to get chewed up and stuff like that. And I'll all of a sudden be, believing them, and the numbers never lie, but the people might.
I'm going to use that. I like that a lot.
So you came to this conclusion. So you're just basically, you're kind of looking at it from more of a quantitative basis now.
Well, I don't know if I'd say that. I mean, the only quantitative stuff I do is kind of the screening, at the beginning of the process of trying to find stuff to investigate. Everything else I do is fundamentals based. I'll just give you the 30 seconds in terms of the way I'm, thinking about the stocks that we have in the portfolio. I'm really looking for the asymmetric return profile or asymmetric value in the sense of, I always start with the question, what if I'm wrong? What happens? If our thesis breaks tomorrow, where is this stock likely to go? So I really try to focus on those companies that are very well supported, both in terms of valuation, but relative to their own historical valuation ranges, relative to their peers. I like to see large discounts that have developed to similar businesses, and then we really focus on balance sheets. So, I basically at the portfolio level, I don't have any net debt, so we've got more companies with net cash than we do with net debt, and we're that is really around that. And this comes out of my time at Templeton, where we had too many stocks that were down 60 or 70%, and almost always, the balance sheet was the genesis of the big move in the equity. And so I put a lot of emphasis on that as a result of that experience. But then, the other side of that is the asymmetric upside potential, and that we define over a 5-year forward horizon. And, to keep it very simple, I'm projecting out fundamentals for the business, and then I'm applying a multiple on those 5-year out, let's call it earnings per share, applying a P multiple to that I think the business should trade at. And that gives me a price target 5 years out. And then I can, compare that to today's stock pricing, get a price appreciation potential. And almost all of my companies pay dividends, so we've got an income component. I add that price potential to the income. And, that's got to be, kind of triple digit over a 5-year holding period. So our hurdle rate is roughly 15% per annum return. The portfolio as it sits today, we think we have a 21% embedded return in there over the next 5 years. So that's, among the most attractive that we've had since we started. So we're finding tons of value right now. But, to kind of bring that all back together, what we've got there is, stocks that we think are really well supported, in a bad environment, bad potential environment. And that based on our dispassionate best efforts, we think, we can make at least a triple digit return over a 5.
All right. So let's just rewind here in terms of to learn how you got to the point where you're managing your own fund here and you moved away from Templeton. You're there for a long time. You moved to Nassau. First of all, what's that like? Now you've lived in California, then you go to Virginia, then you're in Florida, and now all of a sudden you're in Nassau. Did you get any of the island fever? I hear sometimes living on a small island can actually be suffocating.
Yeah, there is definitely some of that. I mean, it's you can't help but feel that you're kind of on I think some people talked about the habit trail feel where you're going across the same little, stretch of land and the same little paths.
Right.
The cure for that is a boat. So I had that. We would, made good use of getting around to the out islands. There's a lot of uninhabited smaller islands and island chains that are just beautiful. So you can just go drop an anchor in a cove and hang out for the weekend with the family.
So you a motorboat or is it a sailboat?
I had a 47-foot motor yacht.
Okay, so you and it had a cabin and stuff, so you could sleep in it.
Yep.
And so was that kind of your weekend fun, was to go explore everything? And what was the farthest distance you went?
Boy, that I don't know the for sure answer to that.
Did you ever go to I can't remember what's closest, St. Bart's too far?
We stayed within the Bahamas, so we never went.
Oh, you stayed within. Okay.
100 miles.
Yeah. Okay. Fair enough. And so that was the key to that. And so you're there, you're managing money in that, and what you went there so that you could manage the big fund. Is that correct?
That's right. Yep.
Yeah. And so the big fund, I'm sorry that I'm not more familiar with it. Yep. So is it also, it's foreign equities only? Is that correct?
Yeah,
or is it everything?
Exactly. So there were two primary funds that, we had the bulk of our assets in, and, including a lot of the kind of clone accounts that we had that copied these funds. So the amount, I was running around $15 billion in large non-US, value basically.
Right. Okay.
And then that fund was called the Templeton Foreign Fund. And then the Templeton Growth Fund was our largest fund, which was a global And even though it was called growth, it was also, that was John Templeton named that for growth in capital, not growth style. So, it's a consistent philosophy, but two separate funds both run out of Nassau, and that had to do with historical tax reasons. So,
and what was it like moving from the small cap fund to the big one? Like, what was that experience like? And what were the lessons you learned and took from that?
Yeah, well, that had a lot to do with why, when I started Bergen Park, I decided to focus on small and mid caps. It's a much harder job to outperform as an active manager in large cap. I don't think it can be done. I did it over 12 years, but the spread of outperformance was lower than what I was able to do in small cap. And that, it's, I guess if you're like me and you're talking about this a lot, most investors will nod their head when you say it's an inefficient part of the market, part of the global equity universe. But what that really means is that you can find crazy prices that you just would never be able to find at a, $50 billion company. But those things happen all the time if you're looking at a $500 million company. So, when I wanted to build Bergen Park, I thought I'm going to build a boutique. We're going to focus on non-US small and mid caps, and we'll be able to generate very good returns, and we'll close it before we get too big. And, we'll have a nice little business, and we'll make our clients a lot of money.
I got it. Now, this entails investing in non-US dollar assets. Do you hedge the currency? How does that work?
Yeah, the default for me is not to hedge it. And the way that I think about that decision is only in the situation where I thought the US dollar was significantly undervalued would I hedge the currency exposure. And in fact, in 2008, I actually did think that, and I made that case to our CIO at Templeton, but and he agreed with me in principle. But there was just too many. It would have created too many problems, so we were kind of stuck with our strategy. But in a situation like that, the euro, if you remember, I think it peaked at 158 or something like that.
Right.
And that was a pretty obvious case where hedging would have made a lot of sense. So we're kind of at the other end of the spectrum from that. The yen today is significantly undervalued. I'll give you an interesting data point I saw. So if we start in 2008, the average American worker made $44,000, and the average Japanese made $35,000. So, they're kind of in line. Guess what those numbers are today? The average American worker today makes $77,000, and the average Japanese makes $28,000. So they've
on. Oh, because they do a US dollar equivalent. Okay, yeah. I get what you're saying.
Yeah. So
wow.
That's the degree of the currency move. Plus, Japan has not had a lot of wage inflation. So it's, and that's a great thing if you're, a Japanese business. Not great if you're a Japanese worker necessarily, but for Japanese stocks, they really have, with domestic operations, they're very profitable.
How much do you think about currencies like that? Like you had those numbers right on the, the edge of your fingertips. Mm-hmm. Do you know roughly what you think of as fair value for a lot of these emerging markets that you're trading, or not? That's not an emerging market, but if you were to buy something in Vietnam, do you have a view on
I should
call the Vietnam dong?
Say too that, my focus is developed plus the kind of the top tier of emerging. So maybe the top 5 emerging markets. So Vietnam.
So what are those top 5? Could you just list them for us? So it's China.
Yeah. China, India, Mexico, Brazil, and I would include South Africa too.
Okay. So those are your 5. Okay. So you do non-US, the big non-US ones plus those 5. Okay.
Yeah. And Hong Kong, Korea, I'm including in developed. So.
Oh, okay. Yeah. Fair enough. Okay. And so let's just take Korea. Do you have the same sort of idea about what the Korean currency should be worth and stuff? Are you thinking about the currency on it? Is macro, let me just say it this way. How much of macro is going into your analysis, if any at all?
It's not, it's definitely, unless there's geopolitics for my Chinese holdings is important. I try to keep very on top of that. But when it comes to doing the company analysis, it's I would say the currency is actually probably the biggest macro issue that I do take into consideration. I don't really spend too much time on GDP and current account surplus, those kinds of things. That's just sort of too far away from my core focus. But with regards to currencies, I maintain, I'm a value guy, so I'm looking at 30 years of inflation differentials. You can do this through Bloomberg. They have some relative purchasing power parity tools there. And
right, just type in PPP, folks, for those with a Bloomberg that want to do it.
Yeah, so it's basically the idea is you fit the currency pair over that relative inflation line over 30 years and try to do a best fit. And then when the currencies get very far away from that central, currencies over time, they should follow relative inflation. That's where they should, but they obviously don't. They go all kinds of different directions. But that approach over periods longer than 3 years and especially when you're far away from that central tendency, then you have high probability kind of an outcome of that the currency pair moving back in the right direction, and it usually does that. It can do half-life of that retracement is 3 years, I think, roughly. I guess the takeaway for me is that, so for example, Japan on that analysis today, the yen is about 65% cheap relative to where it should be, quote unquote, on that if you're looking at US inflation versus Japanese inflation and then fitting the currency pair.
Right.
So we've built in about half of that. We are giving Japanese companies credit in terms of the yen coming back. And that's obviously for domestic, from a US dollar perspective, that increases the US dollar earnings as the yen appreciates.
So if you were to look at this and when you're trying to weight your portfolio, you would put it into your valuation as opposed to tilting it because you believe that the yen is more undervalued.
Yeah, I try to manage this portfolio based around the numbers that we've got in our database, and those numbers are the 5-year forward expected total shareholder return, which is driving a lot of my decision making. So, for things, by the way, I don't, there's only two currencies that I'm giving some credit to. They're the euro, which is roughly 45% cheap, I want to say.
Yeah,
something like that. I don't have that at hand. But and then the yen. Okay. So those are the only two currencies right now that we're giving credit for. And again, it's going to be.
So everything else you just consider even up.
Yeah.
You assume that the status quo is correct.
Well, I would say that, we're in a pretty extreme period right now in terms of these currency values. That's very unusual that you'd find those kind of discounts for major currencies. Okay. So that's why I'm building it in. I would say is a normal state of affairs. If it's only 20% expensive or cheap, I'm not going to adjust for that. I don't have any real good. There's no good. The quality of that view is pretty low, as opposed to when you're 65% cheap. Then that's very interesting. There's a real edge. Think about that $77,000 American worker versus the $28,000 Japanese worker. I mean, those kind of things don't last. Those get corrected.
I'm with you. I don't understand why it's on more of an issue. Like, how does GM compete against Toyota?
Well, a lot of Toyotas are made all over the world now. So
no, fair enough. I understand, but on the whole, there, I'm just kind of picking two companies on but
it's relevant for small caps. Definitely. Certainly, exporters in Japan have been very successful in this environment. But as the yen appreciates, obviously their margins get hit on the way up. So we've been looking for more, domestic focused Japanese companies. I've got about 15 or 16% of the fund currently in Japan, which is down from where it was a year ago, but still see a lot of good value there.
So the reason I had you on is one of our mutual friends talked about the fact that you were noticing that there's all sorts of value in all these companies. Can we just talk a little bit about the big picture, why this is occurring and what you're noticing? Like, you have many decades of experience doing this. And I think you're it reminds me of Top Gun when when Maverick says to Goose, this is a target rich environment. And that's kind of the impression I get that what you're experiencing. So first of all, could you confirm that is the case? And then why has this developed?
Yeah. Okay. I'm going to give you a few stats on the portfolio, maybe to start, because, I share this with people, and, if you're an equity person, these are pretty powerful set of numbers. So across the portfolio, I'm going to give you average numbers across the portfolio. So our trailing 5-year sales growth has been 15.5% per year for the companies in the portfolio. That's a very high growth. That's in line with, Microsoft and Apple and Google. They've grown at roughly the same rate over the last 5 years. So we're owning growth businesses. Now you have to pay, call it 30 times earnings to own those 3 mega caps. You only have to pay 8.5 times for the companies that are in our portfolio. And if you look across the free cash flow generation, we've got 13% free cash flow yields to equity. We've got 17% free cash flow yields to enterprise value, which is picking up some of our strong balance sheets that I spoke of. If you look at net debt to market cap, we're basically zero. So we don't have any net debt across the portfolio. And then, as I mentioned before, 2/3 of our companies are buying back stock, and the dividend yield across the portfolio is just under 5%, 4.8%. So that is, we've got growth businesses. We're paying kind of half normal multiples for that in terms of PE. I didn't mention EV/EBITDA, but that's 4.5 times across the portfolio. So again, that's probably 1/3 of where the S&P is, or maybe even 1/4. I think the S&P is probably up around 15, 16 times. So we're at 4.5. And those free cash flow yields are real, so these are, highly cash generative businesses. The balance sheets are pristine. And then, the dividend yield plus the buyback, that tells you we've got management, doing the right thing by the buybacks and payouts. And that, it's going to be hard to lose with this, absent some geopolitical, disaster.
Right. And why do you think this exists? Or so first of all, let's compare this to, what was it like pre-COVID? What were your numbers like? Were you finding deals of this sort, or is this just gone like mind-bogglingly more cheap?
It basically what's happened since pre-COVID is that the, kind of the opposite of our world. So we're, small non-US value. So that what's the opposite of that? US mega cap growth, right? Which has been driving returns for a long time, at least,
right,
a decade plus. But so what's happened in the last 5 years is that our little part of the market has kind of turned around and hasn't really done much. But obviously the indexes have marched on, driven by, margin expansion and also, good fundamentals, let's be honest. But these companies now that are, 33% of the S&P, I believe now, the top 10, which is a historical high. We've really gotten very concentrated in terms of, where the performance has come from. And of course, if that should go into reverse, and I'm not, I thought it should have happened by now. I thought it was already in the works in 2019 when I started the firm. So I was clearly very early and wrong on that. But I still think that that's an inevitable, if you look over, the last 50 odd years, the US has outperformed, in, typically 5-7 year stretches, and then it goes the other way. So we've been in a very unusual period. Let me give you one stat, actually. From 1950 to 2014, the US and the rest of the world actually had identical equity returns in US dollars. So we went 64 years. I didn't
realize that.
The US did not outperform for 64 years. But since then, the US is up 520% since 10 years ago, and non-US is up 140%. So that's the degree of outperformance that the US has had over the last decade. But as I say, at some point, we're going to shift into another regime, and we're kind of the opposite of the stuff that's been driving returns. And we have been completely neglected in terms of, investor interest, new money. There's just, institutional investors only, I'll be honest, very savvy investors are looking at us, but it's not a lot.
Right. A couple of things. First of all, I'm with you. I've been calling for the end of this, U.S. Kind of, let's just say, dash into the U.S. Like eventually, people will say, well, why am I paying this huge premium to own US assets when I can go buy other assets for a cheaper amount? And one of the things that people will say is like, oh, it's this indexing, it's this rush to indexing, and it makes it so the non-indexing stocks do poorly. And I go, yeah, okay, I get that. But doesn't that assume that the market is incapable of kind of self-correcting? And aren't they kind of not giving the market enough credit for eventually repricing correctly? If you understand what I'm saying, like,
Yeah.
aren't they kind of being defeatist in terms of saying, well, indexing is going to make it so that it only the biggest stocks ever win? And I go, well, if you take that to its extreme, that means that like all these other stocks just keep getting cheaper and cheaper. And eventually they're going to get to a point where it's going to make sense to buy them. And I got to feel like we're there.
Yeah. I mean, I agree with your general approach there. The other thing on index, and by the way, I'm not a student of money flows in and out of, mutual funds, passive or active, but, you got to think too about the aging of the investor base. I know like I can speak from experience with my mom, for example, she's, harvesting her investments to fund her lifestyle. And as that starts to be, more common, obviously, it's not always passive inflows, is my point. At some point, passive goes outflows too. And, if and when that should happen, obviously, there's a lot of room below from where we're starting in terms of valuations and the index heavy stocks.
One of the things that you mentioned is the fact that institutional investors, only the most kind of savvy are starting to look at this and realizing that this is a cheap asset class. Do you agree with me that U.S. like large cap growth is probably one of the most over-owned assets in terms of the weightings throughout the world? Like, because you must talk to investors all throughout the world and see kind of how their portfolios are set up. Like, it almost seems to me like you could almost argue that your portfolio is just a natural hedge to what they already own.
I think that's a great point. I just remembered a data point I saw the other day that NVIDIA's market cap is greater than all German stocks combined. They just passed Germany. Go ahead.
No, you finish your thought. I'm sorry to interrupt.
Well, I think, what was, remind me again, because I got myself off track.
In terms of the whether when you talk to institutional investors, whether the U.S. large cap growth is as over-owned as I kind of believe it is.
Yeah. I think that, I'll tell you what, it's a funny thing. And I've kind of seen this a few times in my career already, but when something is working, people are very reluctant to take the trade-off. It's sort of just this muscle memory, inertia kind of factor. And, they have warm feelings for the stocks that have been performing well. And it sort of has to run out of gas. And it's like, I remember in 2000, there wasn't a catalyst that kind of came and, knocked down the NASDAQ. It just sort of overexpanded to the point where we had so many .coms competing for space that it just sort of collapsed on itself. So I don't know where. Obviously, I thought it would have happened already starting this firm in 2019. I kind of was doing that with this view in place. But it will
eventually kind of change.
I did want to
kind of change things.
And I don't know what the catalyst will be, whether or not. Well, I do have one catalyst in mind actually, which is the Europeans have recently enacted legislation over there that's very aggressive against the big platform companies. I wrote about that in my quarterly letter a little while ago. And I think, if you look at what happened in China in 2021, what they implemented in China, they actually borrowed from the Europeans. So it's a lot of the same language that went into the regulation in China that, knocked Alibaba and Tencent and the others down a few pegs over there. So those stocks have really been poor performers over the last 4 years. And, a big piece of that is because the regulators decided to crack down on those businesses. Now, China and Europe are not, there's a lot of differences there, but I do think that this is a bigger deal and it's coming eventually to the world that will, it could cause people to consider these businesses quite different and could really change their profitability and B, their growth potential.
I got it. All right. So, I'm sure everyone that's, listening is dying to know some names that you like. Why don't you just pick maybe could you give me your top three that you'd be willing to talk about?
Yeah.
Maybe one from a different country of each one. Let's start with Japan. I'm a huge Japan fan, if you don't mind. Like I've been loving it. I think
let me
it's a great.
Let's see here. I probably should have had a few queued up already, but
that's all right. We got time.
All right. Well, let me start with one. This is actually I think it's the second largest in the fund at the moment. So this has been a kind of a key holding over the last maybe three plus years. The company's called Zen Game. It's actually listed in Hong Kong, and the ticker there. Oh boy, like
2660.
2660. Yeah.
Yeah. Okay, I'm with you. Okay.
Well, don't quit on me here. Yeah.
Zen Game.
Yeah. So, this is kind of this is maybe a poster child for what I went through with regards to, the characteristics that you can get. This is about a $460 million US market cap company. And they've got about 60% of that market cap sitting in net cash, and they're paying out a 6.5% yield. But I think there's a reason they did a special dividend last year, and I think there's a reasonable shot we get a special dividend this year. If they don't do something else with that cash, and they may buy a competitor over there to expand. But basically, the enterprise value is $190 million US dollars. And the most recent 12 months, they made $103 million US dollar net profit. So your
really?
your enterprise value to profit is 1.85 roughly, less than 2 times. So the yield to enterprise value here is 46% or 50 plus percent. And pay a dividend. They're buying back stock, so they are doing that. And if you look at the growth, I mean, here I'll just read off. So starting in 2019, this is top line growth: 19%, 12%, 98%, 20%. Last year they did 17%. So they are growing great. I'll tell you what they do. They make games for your phone, but they focus on traditional Chinese tile, board, and card games. So Mahjong is a big title for them, and these are played by older Chinese people typically, and they don't they play together, so they don't tend to swap out of the game that they use. So it's a very sticky business. And they're doing a very good job of monetizing their user base. That's where most of the growth has come from. That users are still growing, but.
All right. So that's a great example. Now, one of the things you did mention earlier, the China geopolitical risk.
Yes.
How do you think about that? And how does that, factor into your investment in this company?
Well, I think, if I had to, I think the most likely outcome that I'm scared of is that the U.S. will one day basically say Americans can no longer own Chinese stocks. We'll have you have 60 days to sell your, Chinese securities. Now, I don't know how do you, guess exactly what the potential for that is. I mean, I think it's, reasonably large than the next 5 years, maybe 20, 30% possibly. But that's one guy sitting here making a guess.
So let's just go backwards, because most other people would be worried about the other way. Most other people would be saying, I'm worried that China is going to, zero your company. They're going to take away, your rights to own that company, or they're going to invade Taiwan. And then the U.S. is going to be forced to do what they did to Russia, to China. Do you worry about either one of those outcomes?
Well, I think the U.S. doing the U.S. might have a provocation to do that, but I don't think the Chinese are never going to turn down, Western money. But in terms of the Chinese getting in there and really meddling with a small company like this, I think it's pretty unlikely. They certainly, I think the proper frame for understanding how Chinese, the top of the CCP thinks about corporate power is that they want to make sure the CCP is the unquestioned power. And they don't have to worry about Zen Game on that front, but they do have to worry about, Alibaba, for example. Jack Ma got in trouble and kind of spoke out of turn back in 2020, and that set off that kind of regulatory cascade. So, the communists put themselves back on top, and that's very clear today. So I don't think they have that anxiety.
Okay. So your the size of your companies make it so you're not worried about a political side. What about them invading Taiwan? Do you worry about that?
In the long run, I think that, if there isn't some kind of unification, that's a reasonable expectation, but that's the long run. I mean, I think the Chinese calculation there is that, I think if Taiwan were to declare independence, then there's probably a Chinese invasion, but I don't think that's likely. I don't think the Taiwanese want that, and I don't think they're going to provoke the mainland. And I think China just thinks that, it's a rising power and the U.S. is a waning power, and that time is on their side. So there's really no incentive for them to, do something rash right now. Why not wait?
I have this buddy, Louis Vincent Gav from GavCal Research, and he points out the craziness of people who say they can't invest in Chinese stocks because they're worried about China invading Taiwan, yet then they're stuffed to the gills with NVIDIA. And he's like, it's not going to work, like NVIDIA, if Taiwan is invaded by China, NVIDIA is in trouble. And I do think that's that paradox of people rushing into companies like Apple and NVIDIA that are very China's, dependent, but yet saying I can't buy Chinese stocks because I'm worried about the geopolitical risk is actually kind of funny.
That's a good example. I like that.
Yeah. All right, let's go. Do you have a Japanese stock you can tell us, or do you have another pick you want to give us?
Yeah, I do have. I've got a lot of different stuff here, but I thought I would mention this one. This is a pretty simple little story. This is a Singapore listed company called HAPAR. You spell that. The symbol is HPAR in Singapore, and the company is spelled HAW, new word PAR Corp. But this is a tradition. This is a kind of a straightforward, discount to net asset value story. So there's basically 4 buckets of value in this company. They have a big holding in UOB, which is the leading Singapore bank, or number 2 after DBS. They also have a reasonably large holding in a land company called UOL, that's also Singapore. Then they've got some net cash. And then they also own Tiger Balm. I don't know if you have ever run across that, but that's
like the stuff you put on your muscles or whatever.
Yeah, exactly.
Okay.
So it's a bit of a, it's kind of an oddball company, but
hodgepodge of different assets in there.
Yeah. But, so you get a lot of dividends coming through from UOB. It's a big dividend payer. I'd have to double check it, but I think it's around 6% today. But long story short is you're paying about just over 60% discount. So, you're only paying 39% roughly of what I think the net asset value is there. And it doesn't, the kicker here is that the dividend yield on HAPAR, which I'm going to double check right now,
4%.
It's not all that high. And so people, kind of stay away from it for that reason. But every 4 or 5 years, they pay a special dividend. And that's, ultimately they top it up. The yield's 4.1% today. But if you actually look at the history of paying specials, and this company's got a lot of net cash currently relative to its market cap, which is, call it, what is that? About almost 40% of its market cap in net cash. But the value of its UOB stake by itself is worth what the value of this company is. And then they've got, Tiger Balm, which I value at somewhere around 60% of market cap. So, you've got more than enough value. And as I already mentioned, the net cash, I call it 40 cents on the dollar. So right there, you're already 2x the stock price in terms of the underlying assets. And then they got UOL, which is worth, another 20 or 25% of market cap.
Why does this even exist? Like, why don't they just, buy it back? And, why don't they buy their stock back instead of, first of all, giving out dividends?
Yeah, that's a good question. And I haven't talked to the management team in terms of exactly what their plan is for, the proper, apparently, in Asia, in Singapore, there's no taxes on dividends, right? So, the incentive for them to do a buyback is different. But, for us, yeah, that would be better.
Yeah. All right. What else you got for us?
All right. Let's see here. Let me go back to my list and pick a Japanese company for you.
And how many companies do you have in your portfolio?
It's 30 to 35 has been the range.
Okay. And like 5% is the top weight, kind of the deal. Like,
yeah, 6%. The top
okay,
10 is
6.
usually around 42%. To give
Okay.
you a sense for. All right, I'll give you Mitsui Matsushita. Let me gonna open up my file on them.
Mitsui.
So this one is actually worked out pretty well, and is basically almost out of the portfolio at this point. But it's an interesting story in the sense that so what is this thing? It's historically it's a coal business, and they're basically their asset, which is in Australia, was not approved to go on beyond this year. So
Okay.
about 3 years
Before
ago.
we go on, is this 1518 in Japan?
Yeah, that sounds
Okay,
yeah.
great. Okay.
The attraction here was that coal went parabolic during the Russian invasion and after, so this was a huge beneficiary of that.
Right.
And they were already changing their stripes from being a coal business to they're basically now what they're going to be is a collection, maybe 6 to 7 industrial and consumer businesses in Japan. Not tremendously exciting, but nice little solid businesses. But the valuation was a huge attraction here. So what basically happened was with the end of their coal business, they were printing money, and this ran their cash balance all the way up to just underneath where the market cap was. But so the market implicitly was no longer paying for the other businesses that were, my recollection, generating about 5 to 6 billion in net profit. That's yen. But if you put a 10 multiple on that, you get a 50 billion value to the operating businesses that are going to be the nature of the business going forward. And if you look at the stock, you can see the stock has done well. I mean, we purchased this about 6 months ago, so it was back around 2,600. But so I guess the point here is that when we purchased it, we had basically the market cap was in net cash, and we got roughly 50 billion worth of businesses for nothing, and that's worked out pretty well. There's actually basically an activist got involved here in order to basically get and you can see the stock price ramped pretty hard, and we exited most of our.
Was that a Western activist or a Japanese activist?
I have to go back and remind myself who that was.
And is that something you're seeing more of? Like, as you tell these stories about companies that you can buy that you're paying just what they have on cash on the books, it's kind of amazing. It makes me think of that time. Wasn't it Benjamin and Graham and Dodd that that talked about doing this way back when? Like this that usually shouldn't exist, right?
No, it shouldn't exist. And, once again, I mean, this happens all the time. I mean, you have to be on the lookout to catch this stuff, but that's what I've been doing for 25 years and, got pretty good at finding them, and they're out there. You just have to really keep digging. And, there's just all kinds of situations where let me give you one other example if I can, actually.
Okay, sure.
This is another Hong Kong stock that is it's called Wasion, so that's spelled Wasion, and I'm just going to pull it up here in Bloomberg.
3393.
Yep, you got it.
Okay.
And this is this stock is another one that's worked out pretty well. But I originally got involved with this stock. It was below 3, and at the time, so I'll just try to sketch this out as simply as I can, because this is the widest discount for the same asset, or the farthest apart prices I've ever seen for the same asset. So basically what they did was they listed that they're listed in Hong Kong. So they had their, kind of their most attractive subsidiary. They listed 40% of that over on the mainland in Shanghai. And the valuation that they got in Shanghai, they still own 60% of it. So if you use the market price that came from Shanghai on their 60% ownership, it was worth 3.5 times the parent's value. And the parent actually still had, roughly half of its earnings in other businesses that were not listed. So it actually had way more value than what it was listed over in Shanghai. Now, I'd never seen anything like that before in my life.
That's like Palm. Remember Palm and Triple M?
Yeah, but that wasn't anywhere near that, right? That might have been.
No, it's not. Or I think Nortel and Bell was the same way, but not to this degree. So you're saying that you could buy $1 of 3393, and you were really getting almost $4 of this thing that was listed on the other exchange?
Exactly. So that gap persisted for 2 years, and only in the last 6 months has it really narrowed. So once
And
again,
why
I
is
didn't
it
know it, you know,
why did it narrow? Do you know? Like, is there a reason, or just
somebody else found this, probably somebody who owned the subsidiary over there, and said, let's look at the parent. You know, I
and
mean,
is it still there? Is there still a gap at this level?
there's still a gap, but it's more like 1.5 now. So the subsidiary has done okay. You know, it's up maybe 20% in the last 6 months, but the parent's up 150% in the last 6 months. So that's closed a lot of that gap. So eventually it worked, but I had to wait for 2 years on that one. You know, it wasn't
And
doing much.
you'll never short the other side, right? You'll just be like long something you
Yeah,
think is
I don't.
cheap.
Yeah, especially it gets tricky over in the mainland.
Okay, you can't even short, in essence, especially us. All right. Well, that's great. Listen, it's been a real pleasure chatting with you. Before I let you go, I got to talk a little bit about where you live now, because you went from Nassau, Bahamas to Montana. Can I ask why that was? Like, was that a lifestyle choice, or like, is that
I mean, in a sense, I think it's probably about as opposite of the Bahamas as you can get. I live, you know, at the foot of Glacier National Park, so it's quite a change. I think I probably got enough sun and sand and sea for a while. But no, I mean, it's just beautiful up here. My wife actually was the primary, petitioner to move up here. We went to Glacier for a couple summers and just fell in love with the area. You know, the natural beauty. And
oh, you guys aren't, nobody's from there. You actually just chose it. Like, you decided that this.
We were coming back
Oh,
to the
wow.
U.S. and wanted to be in the Rocky Mountain region, and ultimately decided that this part of the world had what we were looking for. And so we've been very
That's
happy.
awesome.
You know, it's not for everybody. It's a little cold in the winter, but I like the cold. And
Well, it's even a little cold in the summer, to be honest. Like, like, I'm not sure where you guys are, but in Calgary, which you're not that far from Calgary,
well, that's right.
they get snow in the summer. Do you ever get snow in the summer?
Yeah, well, I mean, I don't think it's since I've been here, which is not that many years now, but we have not had snow in July or August, but we've had snow in every other month.
Oh, okay. And so is Whitefish your ski hill that you go to?
Yeah, that's, you know,
Okay.
the local is called Big Mountain, and it's actually, you know, quite good.
Oh no, it's a good hill. Like, there's no doubt about it. Do you ever get up to Fernie?
No, I have not. I haven't been up there.
Oh, you got to go. You got to go to Fernie. Fernie's a lot of fun. And then if you're interested, I don't know, have you ever gone cat skiing?
No.
Because if you want to go cat skiing, there's a good place there. It's called Island Lake Lodge. It's right beside Fernie. And it's a terrific thing. And I think our Canadian dollar is going to get a lot cheaper. So you could probably do it on the cheap.
Right, I'll watch that.
All right. So listen, it's been a pleasure chatting with you. For people that want to learn more about your fund or yourself, what would you suggest? Where should we send them?
Yeah, bergenparkcapital.com, and there's contact information there. And that gives a nice overview of the firm, I think.
Okay, terrific. It's BERGEN parkcapital.com, and it's Tucker Scott. Tucker, thank you so much for being on the show. We really appreciate you sharing your life and story with us.
Well, thank you very much for having me on. I enjoyed it.
Take care. Bye-bye.
Bye.
All right, Patrick, it's time for Talking Charts. What do you got for us?
All right, let's just start off and talk about the top 3 things we were watching 2 weeks ago. And we were watching all those flash services and manufacturing PMIs. Did you take away anything? I mean,
there was
the
some
economy
weak ones,
continues
actually.
to be weak.
Yeah, no, there is. It continues to surprise on the downside, although there was some mixed ones, because there were some that were on the positive. As usual, it's like there's no clear signal coming out of any of these.
Yeah. We'll see whether there's any revisions or anything on that. We were also, number 2, looking at as to whether there was going to be a bottom in the energy space. And while oil's been still very sluggish, I mean, it certainly has tried to break out a little bit on the upside, but gave it back. Energy stocks are up today. We'll take a look at that chart in just a moment. But it's too early to still identify that a bottom is in on it. But there's certainly one of the sectors that I think now has some asymmetry to it, as they've been correcting for several months now.
All right, what was the number one thing we were watching last week?
We were looking at those precious metals and whether or not they were going to keep trucking along. And, well, you know what? They've begun a little bit of a correction. And so we have a scenario now where, well, actually, let's pull up the chart Well, I'll tell you what. We'll look at the chart when we get to the charts in a moment. Let's talk about the top 3 things to watch in the next 2 weeks. First thing I wanted to watch was what happens with the ECB and I should say central banks, because Bank of Canada is also coming out as well. Is there something you're watching from these?
Well, the ECB is on June 6th, it's meeting, and it's actually got a full cut priced in. So this will be the first kind of major central bank we've seen that will actually be doing some cutting. And it'll be interesting to see what the market, if anything happens. Obviously it's already priced in, so it should be no surprise. But sometimes, that kind of just hitting it over the head and the reality kind of forces folks to realize that the world's changing and maybe it will actually have some ramifications.
There you go. So number 2, we're at the jobs numbers coming out next week. And we've already talked about numerous times how even if these jobs numbers come in flat, the revisions that come in could be completely different months forward. But it's certainly the thing to watch in terms of those that are looking for some sort of evidence that the economy has truly rolled over. And the jobs numbers have dug in and held month after month with no sign of weakness. And here we are once again going into the summer period. It'll be interesting to see whether or not the jobs numbers stay at these kind of levels pinned in this area.
Yeah, Patrick, the reality is that with the weekly job numbers that you get, you can pretty well guess what it's going to be. And there is some variability in terms of the actual month to month. But, as you mentioned, the reality is that we have a situation where the job market has been somewhat strong, but loosening up and becoming a little more weak. I don't think you're going to get a big surprise on the jobs numbers.
Yeah, I'm with you. No, at least not in this one. Like maybe later in the summer there we could see something, but I don't think this 1st of June or the first week of June one is going to be the one that cracks. Number 1 thing to watch is the inflation numbers that are coming out. And that's that's on the upcoming week, but the week after. But certainly this continues to be the conundrum in terms of will they be able to start cutting at some point? And the sticky inflation has been the thorn in the side of Powell, and whether or not he was going to start cutting at some point. What are you looking for here?
Well, I do think that the inflation numbers are the number 1 thing to watch, because we all know that the central bank, the Federal Reserve, wants to cut. They just need an excuse. I don't know if one inflation number is going to be enough, but we've now had 4 or 5 inflation prints that ended up being hotter than expected. It will be interesting to see if we get a weak one, whether they will immediately take that opportunity and try to sneak in a cut. Like, we'll get a feel for how keen they are to actually pull in a cut, and it'll be dependent on us getting a weak inflation number. Without a weak inflation number, if we once again come in line or even a little bit hot, there's no way we're getting any cuts.
All right, let's talk some charts. We'll touch on those energy and precious metals in a second, but let's just hit the S&P 500. After putting together almost 3 weeks of perpetually up days, the market could do no wrong during and then Nvidia came along. And it really felt like the pop in Nvidia started some sort of rotation, and we certainly have seen the market now mean reverting some of those gains it made. It's certainly, I don't want to call this a big sell-off or anything. It's been a correction off the high, but certainly underneath the market, when you're looking at what's happening on some of those Mag 7 stocks and other things, that's where you're really seeing some movement.
I think the market's getting into trouble, Patrick. And I think that there's lots of signs that we're getting some weakness. Things aren't behaving as well as they think. And the complacency is actually kind of shocking to me.
Right. And well, let's start off with just having a look at Nvidia. So this has been the leader, and it jumped higher, had an extraordinary push to the upside, and finally 2 back-to-back days of profit taking, which was inevitable to come in. So the question now here, do the buy on dip traders do what they've done best on Nvidia all year, which is they'll buy the dip? and usually this kind of a pullback as it kind of fills this gap, it could easily find support here, well north of 1,000. Maybe we see another $20 or $30 pullback, but the buy and dip traders, if they are going to still have this push north of 1,200, would typically come in at these kind of levels, and so it'll be really interesting early next week to see whether or not that pattern persists. And the bigger thing is that if NVIDIA doesn't get bought on dip and for some reason sells off, which is not my favorite scenario, but if it did happen, what would that spell for the market? And so it'll be interesting to see how that develops.
If it went down to 920 next week, would you buy it?
No.
Why is that?
Because a stock with this kind of strength should not be pulling back that deep that fast. I mean, if there was some sort of a headline or something that caused a short-term gap, that maybe it would be something interesting to fade, but I think that's too deep. I would buy much shorter pullbacks. If it goes that magnitude, that's a warning sign to me.
I don't disagree with that analysis. I figure like if it went back to somewhere obvious like that 920 level, and it would be like, oh, everyone would be saying, oh, look at this. This is a perfect spot. It's buying, dipping back into the overhead resistance turns into support. If it goes that spot, I think it's going to be one of those things that
because like if it pulls back like this, that would be concerning, and particularly it's been the contributor to S&P gains. Like what was that stat that was like 40% of the S&P 500 profits this year are attributable to just NVIDIA?
Was it that high?
Like it.
I didn't realize that.
Like in terms of the gains on the year, it was some insane number like this. Obviously, I didn't do the math myself, but that was just something that I came across. But point is that NVIDIA, I think, has a huge psychological importance on this, and I think if it began to sell, I think that would be far more ominous for the market. What is interesting is though that we are seeing some clear rotation out of the Nasdaq. Like so, Nasdaq had a pretty distinct sell day today, down over 1%. At one point, it was down close to 2%. And what's interesting is, for instance, the S&P Equal Weight Index is actually up on the day. The S&P 500 now is almost flat. And so we're distinctly seeing NASDAQ names being sold. Like look at the way Microsoft had 2 huge down days. And you look at, let's have a peek at Apple. Actually, Apple held up much better. But you're seeing like even NVIDIA pulling back. And so the point here, even a couple down days on Google, and I'm curious whether there became a new sector rotation because even today, oil's down 80 cents, down at $77, but energy stocks are up on the day. Right, like I'm just use XOP or even XLE. We basically are seeing energy stocks rallying, and it's not being driven by, let's say, the underlying commodity going higher. And so I'm wondering whether or not we just are seeing this rotation where everyone's like, that's enough of these Mag 7s. We're going to go into some of these sectors where a little bit more defensive and that haven't run as far. Do you think that that storyline makes sense?
Well, I think the storyline makes sense. The real question is this just month end kind of position squaring, or is this the start of a bigger trend? Patrick, by the way, while you were doing that, I actually pulled up on the Bloomberg that stat in terms of how much NVIDIA is attributed to the S&P 500 on a year-to-date basis. It is actually 38.5%. Guess what the next closest one is?
Oh,
it's Microsoft. It's Microsoft, Meta, and Amazon with 6.5 to 5.5. Then Google. Then
is Lilly on there?
Google, then Lilly, both at 5s. Then Google at 4, and then JP Morgan at 2.5. And then it's very quickly you get down to a whole bunch of like less than 100 basis points. It's kind of shocking, actually, how top heavy that is.
Very top heavy.
Yeah.
And it's interesting because over the last bull impulse that we saw on driven by Nvidia, what you really saw was divergence in things like the equal weight and the Russell, which basically didn't respond at all to these markets, and didn't participate in the last couple of weeks on those different moves. And so we're once again in a period where this is all about whether or not new flows keep chasing these stocks that have been working. Or, I mean, is there a catalyst that could see the broadening of the breadth of the market in that rotation? But we're going into summer, and summer is typically low volume, usually no big headlines, and I think that increasingly, my thesis is that it's going to be a very boring summer. Like, at some point the market will likely break, but I don't think it has to break here in June. And so I think that it's a fair bet to assume that the markets are going to, whip around in a trade range and probably put in a bigger topping formation in the markets. And it's probably one of those things. It's best to just enjoy the summer.
There you go, folks. You heard it there. You watch. It's going to be the craziest. Like, it'll be like the summer of '98.
Well, only if you agreed with me.
That's true, actually. And I don't agree with
we
you.
would gooch her.
So you might be right, Patrick. I think, though, the reality is that because the market has gotten so narrow, and because I think the economy is actually weakening, that I'm not hopeful that the rally broadens out. And so that's what
I don't think it will either. But I also don't think that the sell-off has to come in right away. And this is where I feel that to me, we could see a scenario where August, September is the months that the market is most weak on the downside, and we could just see that June and July is just a ping pong match between support resistance levels.
No, that's true.
At least that's my starting thesis.
To me, though, that's still all considered summer. Like August, I still consider summer.
Yeah, I really just think that here at the start of June, this is where things can be still very quiet.
Our friend Paulo Macro, and he highlighted a tweet done by Sun Chartist, and it was IWM over Qs. And I think we talked about this before, you and I, Patrick, but that's terrible looking chart.
Yeah, bounced back a little bit today because the Qs had a pretty rough drop, but it did a few days ago make a lower low. That was very clearly there. The bigger question there, we were just talking about these energies, but this is the interesting part. Like, this is the XLE, and you see a pretty distinct up day today. And the question is that it's happening with oil down. And so, you're saying it could be, month-end rebalancing, which is something that it could be right. But I'll be watching to see whether or not the bulls follow through on this, or whether we have one big energy update early next week that spurs that liquidity flow and actually gets this sector started up. It's one of my sectors that I'm watching to see whether the breakout happens. And right now, it's an up day, but the one day doesn't make a new trend. So we're going to have to see early next week how this continues to develop.
I don't disagree, but I do counsel that it is a month end, and I really think that a lot of today's moves are just noise.
Yeah. So just touching on the dollar index, you know what? Let's not. It really is just chop. I think that the dollar will make a big move at some point this year. I think overall, the scenario that I've been calling for a trade range bound summer will also be the case not only for equities, but I wouldn't be shocked if the currency markets are also relatively boring in this window. There's lots of catalysts going into the back half of the year that could spur some volatility, but I think it's going to be pretty boring here for June.
There you go. You seem to be hammering on this boring June. Did you have some vacations planned that you basically are really trying to talk your position up?
Uh, I'm just hoping the market stays pinned for my my iron condor. No, but the what I wanted to though just touch on was what's happening here in gold, and we were just talking about watching these precious metals, and we were when we were our last episode, we were just seeing the breakouts on the upside of gold, asking whether it was going to make another bull run. And this really does have a characteristic of a double top. Now, I don't want to say top because I don't think it's a major top and some big bear market or downtrend is going to happen, but it could very well play out a similar scenario to what uranium's been doing, which is after having an extraordinary bull run, we could have a scenario where this pulls back to 2250 and then just sits in the pocket for a little while before setting up for another bull run in the latter part of the year. I still am generally bullish gold, but this price action is certainly the heaviest price action we've seen in a while.
You sound like you're just kind of despondent and just think we're going to no opportunities, nothing going on, no excitement.
Actually, I think energy might break out.
Okay,
I think that's the air, but it hasn't really confirmed. But I think that's a very interesting place to watch.
I saw that the result was that there's lots of energy shorts out there, so you could very well be correct.
Yeah. What's interesting as well, silver double top retested itself, gave back the entire breakout candle. So we're in a scenario where silver might join that consolidation. Maybe we'll see $29 on the downside there. We already seen copper giving back that gain. What was shocking to me was a week or two ago, just how bullish the sentiment was towards copper. And it's not that the copper story isn't bullish. I mean, electrification and AI and all this stuff is a great story. But it was one of these scenarios where almost every guru out there was out there, talking how amazing this copper trade is. And it's when you see sentiment that bullish, it was inevitable to begin some sort of corrective pattern. And we're now heading down to, I think we'll probably hit 450. The bigger question is this going to be a deeper, more pronounced correction that lasts several months, or is it just going to settle in there and begin the next bull advance throughout the summer? At this stage, my lower target was 450, and so we're only 10 cents away, and then we'll see how it settles in.
I see that Jeff Curry top ticked it when he said it's the trade of his lifetime.
Yeah,
like Jeff Curry, the old Goldman Sachs analyst, I believe.
But even Stanley Druckenmiller, there were a whole bunch of people out there talking the copper trade. When you have that kind of consensus, it just felt like it was due for some sort of profit taking.
Well, not only that, it does have a PhD in economics. So if the economy rolls over, it has to reflect.
There you go. One interesting I wanted to touch on here. I wanted to just touch on the Nikkei, and the Nikkei has had a great bull run up until like March, and it really seems to have started to lag relative to the other developed markets. And that doesn't make me bearish it, but it's interesting to see whether or not this correction is over here, or whether this thing still has one more trip down to 35 or 36,000 on the short term. Right now, it's not very healthy. If it stays below its 50-day moving average on any extended basis, it may signal that one more leg lower might still be coming here.
I'm probably in the lower camp because I'm a bear in terms of equities in general. So my guess is that it goes lower, because all stock markets are headed lower and it outperforms the rest of them.
So the last thing I wanted to touch on was the Euro stock. And what's interesting is the Euro stock was just one of the most beautiful bull trends at the start of the year. just the relative strength, amazing advance. And the breakout attempt on the upside looked a lot like the gold chart to some degree or another. Came for like a double top retest, giving back the gains. At this stage as well, it's interesting to see whether or not this starts to resemble, like it reminds me a lot of what happened last summer in the Euro stock, where it just kept bouncing its head up along its highs in a topping formation before inevitably correcting in the typical third quarter window. And so question is that is the short-term highs developing here on the Euro stock? Well, if you're overall bearish equities, that certainly is starting to look like that on some of these charts.
Can't disagree there. What else you got for us?
All right. Well, you know what? That's I think that's enough for today, Kev.
Oh.
Is there something you wanted to quickly look at that we should mention?
No, I got nothing, Patrick. This is your time, buddy. It's for you to shine.
No. Let's. I think that's great. That's we're good to go here. So let's. Do you have a?
No,
you don't have a chart.
Talking with crayons with Kev, I completely fell down again. I was actually sick this past couple of weeks, and I was like, just lying in bed feeling sorry for myself. But anyways, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Patrick, where can they find you, buddy?
You can follow me at bigpicturetrading.com or on Twitter at Patrick Ceresna. Kev, where can they find you?
Go check me out at Kevin and at themacrotourist.com, or you can send me an email if you want to get some samples of my letters at Kevin at themacrotourist. And listen, we can never have too many friends on this crazy ride. So thanks for tuning in, and now stick around for the after show.
All right, Danny, join the party here.
What's up?
So
first of all, you got to.
So I'm trying this beer. You know what I get this idea that they're trying to like open source the beer and stuff, but I'm just trying to judge it just as a quality of a beer. And this is just an average IPA.
Patrick, it's in the cloud. It's the future, man. You don't get it.
It's the future.
You're gonna have fun.
I'm giving it a 6.6.
6.6.
6.66.
It's in the sky, folks are gonna hate you. All right.
Speaking of drinking, Danny, you had your liver checked.
So I just wanted to set this up 1 second. Before the show, Danny says, start stalking. He says, well, he had my liver checked. And then I was like, no, wait. This is after show quality stuff. So, Danny, what was the result of your liver check?
Do you know what? It was actually really, really okay. And I was incredibly surprised. I got the size scanned. I got it all looked at. And the guy was like, it's absolutely fine. It's all normal. And like,
oh, thank God.
I know. And I was like,
it's shocked. You know what? It's the genetics.
It must
you
be.
Have like
Absolutely.
this centuries upon centuries of that English blood that is just, gradually you guys have figured out how to tune your bodies to handle this sort of liquor.
Yeah, well, I actually have a bit of a fatty liver, so I've been dieting my liver a little bit, but not today. Not today.
Not today, liver.
Well, Danny, that's really good. I think everyone was worried about you, buddy.
Yeah, I know. There's nothing really that exciting. It was just more. I don't even think it's after show worthy, but it's sometimes it's nice to know that the copious amounts of drinking is it's actually good for you.
No big deal.
Anything wrong?
Yeah. So he got his papers. He's on his way to Portugal.
Yeah. Next week.
Oh, that's awesome. Yeah. So you got your place, you got your papers, you're legal.
Yeah, I'm a legal alien. Not to quote Sting or anything, but.
Yeah.
I know the song. You don't know the song, do you?
And so what are you guys going to do in terms of partying in Portugal when you're both there?
Well, obviously now we've got the all clear, so...
Yeah, well, the liver's good.
That it's in itself a party.
Yeah. And Patrick's
so I think
so that's fine. You're dieting his liver, so... Hope he's nutritious.
Oh, it'll be good. We'll do a little surfing, but
yeah. Oh, 100%. I need to buy one actually. So you can take me surfboard shopping.
There you go.
There we go. Okay. Well,
anything new with you, Kev?
No, that's it. As I said, I was sick as a dog, so I just lying in bed feeling sorry for myself.
Oh, well, you know what I am doing tomorrow? I'm having my second 50th birthday.
Oh yeah, that's true.
You know, why would you have just one 50th birthday when you can have more than one?
Why don't you do it every quarter?
Yeah, absolutely. You know, just getting people together and having a great party. Why not?
I mean, so you're doing the Lisbon one because you were worried that your Portuguese friends didn't have a chance to party with you.
And that's exactly it. You know, I needed to make sure that it's an inclusive group, right? And then we just need to make sure everyone had an opportunity.
Well, that's good. I'm glad that you're doing your job in terms of inclusivity. What's going on there? You drinking another one, Danny? You figured the all clear is all okay with you?
Yeah.
Okay.
I'm just dropping shit.
Okay. Well, on that note, everyone, have a great week. We'll see you in a couple of weeks.
All right. Cheers, everyone.